program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.
Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Good to have you with us here at Ausbiz as we get across what happened overnight globally. A bit of a mixed session there, with investors searching for direction in the absence of US government data. Adding to the confusion for investors on Wall Street has been more conflicting commentary from Fed officials over the immediate path of interest rates. Despite this, the S&P 500 and Nasdaq ended higher with more AI deals fueling gains. Amazon struck a $38 billion deal with OpenAI to allow the ChatGPT maker to run and scale its AI workloads on Amazon Web Services cloud infrastructure. Nvidia shares gained after President Trump said the AI chip maker's most advanced microchips will be reserved for US companies and kept out of China and other countries. Shares of Australian-based AI cloud service provider Iron surged after signing a multi-year GPU cloud services contract with Microsoft worth around $9.7 billion. Tesla hit its highest level in 10 months ahead of an upcoming shareholder meeting that could determine Chief Executive Elon Musk's $1 trillion pay plan. And Kimberly-Clark shares tumbled after it was revealed the consumer goods company will buy Tylenol maker Kenvue for more than $40 billion. Kenvue shares jumping on the news. US manufacturing contracted for an eighth straight month in October as new orders remained subdued and suppliers took longer to deliver materials to factories amid the tariffs on imported goods, with manufacturers citing the import duties as a major constraint. On Wednesday, the US Supreme Court will hear arguments on the legality of President Trump's tariff regime. And in the wake of last week's interest rate cut, the Fed's next move is unclear given the absence of economic indicators because of the government shutdown, while Fed officials have offered conflicting viewpoints, with Austin Goolsbee saying, "I'm not decided going into the December meeting. I'm nervous about the inflation side of the ledger, where you've seen inflation above the target for 4.5 years and it's trending the wrong way." On the other hand, Stephen Myron saying the Fed is too restrictive. Neutral is quite a ways below where the current policy is, given my rather more sanguine outlook on inflation than some of the other members of the committee. I don't see a reason for keeping policy as restrictive. Well, the two-year Treasury yield rose to 3.61%. The 10-year is up to close to 4.12%. Markets pricing in a 55% chance the Fed will cut by 25 basis points at the December meeting. Meanwhile, ahead of today's RBA policy decision, the Australian three-year government bond yields are around 3.65%. The 10-year close to 4.36%, with markets pricing in no chance of a cut in the cash rate today. The US dollar index has risen to a 3-month high against the euro. The Aussie is at 65.4 US cents. Oil prices have held steady, with the market weighing up the latest OPEC Plus supply increase, with the group's plans to pause output increases in the first quarter of next year. Brent crude futures close to $65 a barrel. Copper has eased. Iron ore down around 1/3% to 106 US a tonne. And gold is hovering around the $4,000 mark. Bitcoin, that's coming under further pressure, down below $107,000. Let's get across what we're seeing in big tech at the moment, particularly in the wake of those earnings results last week. We are joined by Angelo Zeno from CFRA Research. Angelo, welcome back. Great to catch up with you again. Just before we get to those earnings results, it appears not a day goes past without some AI deal being done among those tech companies. The latest being Amazon, a deal there to supply OpenAI's demand for computing power. I also mentioned there Microsoft, which of course is OpenAI's largest investor. That's struck a deal there as well. It's going to purchase AI cloud capacity from Iron. How would you describe those deals you're seeing at the moment?
Yeah, so Andrew, thanks for having me. I'd say overall, the way I would look at these deals is the fact that we remain in a very supply-constrained environment for compute capacity. And especially when you start thinking about NVIDIA's GPUs, and when you look at a company like OpenAI, which is looking at some significant growth potential here over the next couple of years, they're trying to lock up as much capacity as they possibly can on the compute side, so they can start rolling out some new offerings, whether it be attached to Sora AI, which they just rolled out here over the last couple of weeks, or even announcing a new search platform, as well as other key potential offerings that they could announce here over the next couple of quarters. They need to lock up more and more capacity, and that's what you're seeing them do here in the markets. And when you actually look at some of the bookings numbers that we just saw over the last week from some of the hyperscalers, whether it be Microsoft or Alphabet, among others, it does point to the fact that there is an expectation for significant room for demand growth for AI workloads, and I think that's a very good sign here across the tech ecosystem.
Well, let's get to see how this is playing out, particularly for earnings in the wake of some of these deals as well. Why don't we start with Microsoft, what you're seeing there, given you've spoken about, obviously, its investment there in OpenAI. Also note that it plans to some $15 billion of AI investments in the UAE. That's just been announced too, I think. What did you make of its most recent earnings result?
Yeah, I mean, as far as the reaction that we saw in the shares of Microsoft, it wasn't, I think, as indicative as what we're actually seeing from a fundamental perspective. I think the fundamentals still look extremely good in terms of their ability to grow the top line at a mid-teens perspective. And then when you actually look at what they're doing on the bottom line, really kind of managing the CapEx growth very nicely with kind of just moderate increases on the operating expense side of things. So I think they're doing a really good job in terms of managing these costs while seeing the higher revenue growth. Now, that being said, I'd say that what maybe hit the street a little bit, some investors out there, is the fact that they did change the tone a little bit in terms of how they plan to spend on CapEx here. Last quarter or 2 quarters ago, they essentially highlighted the fact that they expected CapEx spend to moderate in their current fiscal year. They changed that tone around this earnings and actually said they now expect CapEx growth to accelerate. And a lot of that has to do with the fact that they are now seeing north of 50% growth in terms of their bookings, and that's really important. So the higher capex is justified by the demand environment, but nonetheless, I think that changed the tone from management really is what caused the shares to underperform post earnings.
Well, likewise, we're seeing with Meta obviously ramping up its capex spend on AI. In fact, off the back of its results, share price was hit quite hard there, wasn't it, despite an earnings beat?
Yeah, I mean, and to be honest with you, when you look at Meta, they actually grew faster than all the other companies out there, even though the fact that they don't have a cloud business, right? They grew the top line about 26% here in the third quarter, significantly above our expectations, where we were looking for growth of about 22%. But I'd say, importantly, maybe 2 things. One, in terms of the guidance was roughly in line with where our expectations in the street was, essentially looking at a deceleration towards high teens growth. I think the street was maybe hoping for a little bit more. And the other thing clearly is the expected increase in CapEx spend. I don't think the street trusts them as much as they do maybe some of the hyperscalers, some of the cloud providers, where they can get instant revenue growth tied to some of these investments. So most of their investments right now is almost to an extent a sunk cost in the sense that they're not generating immediate revenue tied to it. So you look at the CapEx spend now going into 2026, while they didn't give a number, it's implied to be north of 100 billion, whereas this year you're looking at about 70 billion, last year about 40 billion. So the step up function in terms of the capital intensity rates for Meta, significantly higher than all these other big tech names. And I think that's the reason they've underperformed as much as they have kind of post earnings.
Well, likewise, Alphabet, it's expected to see capital expenditure of up from 91 to 93 billion full year. What did you make of its results? Certainly better than expected third quarter there. The cloud business, clearly the strength.
Yep. Yeah, I mean, as far as Alphabet's concerned, the cloud business is growing extremely nicely, low to mid 30s. You're looking at even their search and YouTube businesses growing about 15, mid-teens percentage. So all their businesses essentially growing better than expected. They're not a company that typically gives, and they didn't give forward-looking guidance. And I think also on the CapEx side of things, they didn't provide any indication of 2026 at this point in time. So we really don't know. We're kind of working with a little bit of a black box as far as Alphabet is concerned, but nonetheless, all indications are things are trending the right direction. I think most importantly, or very important for Alphabet, is the fact the margins for their cloud business continues to expand, and that's really, really good amidst the period where CapEx spend is going up. So they're executing really well, and a big part of it is because of the control that they have on the infrastructure side. We think they've got the best AI infrastructure and the most kind of cost effective, in the sense that they have those TPUs where they're internally designing and ramping up their chips on that side. So overall, I think execution continues to be very well, but there is an unknown in terms of the CapEx spend for Alphabet going into 2026, and it remains to be seen when they do report Q4 results in late January, early February, whether or not there could be a negative surprise there.
Now, in terms of demand for AI chips, that's certainly the case with NVIDIA, continues to grow. What are you seeing with NVIDIA, of course, having become a $5 trillion company?
Yeah, I mean, as far as NVIDIA is concerned, and very importantly, last week they held a GTC event in Washington, D.C., and they provided some really great clarity in terms of their bookings business, essentially highlighting the fact that they've got $500 billion booked in business here just over the next 5 quarters. So the visibility extremely positive, very good. And when you actually look at the potential upside to street expectations, there is the potential to surprise very nicely when the report here in later November, on November 19th, as well as the fact that as we go into calendar 2026 and 2027, again, that visibility looks extremely low, extremely good, despite the fact that they remain unable to sell into the all-important China market. So when you look at that visibility and the upside to the estimates, I think the street will continue to be very favorable in terms of those shares.
Angelo, great to get across what you're seeing in those mega cap tech stocks. Thanks for joining us on CFRE Research.
All right, thanks for having me.
Let's focus then on what we're expecting locally. A negative start. Now, this, of course, is ahead of the RBA decision, which will drop this afternoon. Expectations, no rate cut. So we'll see how that plays out, particularly as far as equities are concerned. Stay with us. We'll get across the open in just a minute or two.
This program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.